Tattooed Chef is now down about 90% year to date, and I know many people that have lost money in this company. With Jeremy from Financial Education promoting this stock as his #1 company and then losing over $1 million from it, he has lost thousands of subscribers from this. Now, many people are asking themselves if they can trust any financial content creator. And I think the greatest issue about stock YouTubers is that we have failed to talk about the risks along with the reward for each company. Especially in 2020 going into 2021, it was all about the next hype stock that had amazing potential and risks were almost non-existent. So in this video, I want to share the risk that now exists with Tattooed Chef and talk about what it would take for me to buy this company. But I don't want to waste your time, so let's go ahead and dive right in. So TTCF was a stock that Jeremy started buying around the beginning of 2021, and even though he had some great investments like Elf Beauty, Revolve, and Cirrus Logic, some of his most recent investments like Voyager, Tattooed Chef, and the Very Good Food Company have fallen drastically. And because so many people trusted him based off of his prior success, many people thought that they could trust him with the Tattooed Chef investment. And so those people put in their own money as well. But let's look at the numbers and see where some of the risk could come from. Revenues declined 6.7% year over year from 58 million to 54.1 million. TTCF was known over the past couple of years as a growth company. But one thing that I talked about in a video I posted back in February is that the company had SKU expansion, but the problem is that this expansion was not correlating to the revenue growth. So a major risk for the company is the simple fact that despite the SKU and store expansion, they won't really grow what they were expected to grow. And we have seen this over the past couple of quarters. The next metric that is incredibly important is their gross margins, which was actually negative at 7.2% compared to a gross margin last year of positive 8.6%. Now, the worst part about these numbers was that freight costs actually peaked in the third quarter last year. So for the chef to perform even worse with lighter conditions goes to show that there is something wrong with their business model. If they are losing money when things should be easier, then there is clearly a risk that the company will not be able to figure this whole thing out. If I'm honest, this is one of the biggest concerns for the company because nobody is going to want to buy a company who has negative margins, especially in the current economy. And to make matters worse, their operating expenses more than doubled, going from 12.8 million last year to 31.6 million this year. This was a massive move for the company that is only expected to grow 20% this year, and even that could be debated. I would say the most frustrating thing for many investors is that there have been a lot of issues with the management team's execution, and we can see this with the most recent news. On November 21st, it was reported that Tattooed Chef received notice of non-compliance from NASDAQ. The company failed to timely file its quarterly report on Form 10Q for this past fiscal quarter. Now, the issue isn't the fact that they messed up here, but it's actually because this isn't the first time the company has been late or delayed their report. So with everything that is going on with this management team, there's also the risk that the team won't get their act together and really start executing not just on filing their reports, but figuring out how to solve their margin issues and lack of revenue growth. The reality is that because the company hasn't executed on what they said they were going to do, how can anyone trust them now? And this leads to the next caution flag that I have, which is their cash and cash burn. The company reported adjusted EBITDA loss of $25.5 million compared to a loss of $5.1 million last quarter. The company appears to be moving away from profitability. And on top of this, they only have $14.2 million in cash with $20 million in a line of credit. So this brings up a scary situation for TTCF, because even if they lose less money, there is definitely the possibility of the company running out of money. And what's unfortunate about this is the company had over 9 figures in cash this time last year. That's right, they had over $100 million in cash last year, and all of that just disappeared in a matter of a year. So with the company burning that much cash, the management team is not only going to have to figure out how to fix margins, but how to have enough cash to stay afloat. And to do this, the company intends to raise additional debt or equity capital in the near future. So in other words, they're expecting to accumulate more debt or even dilute shareholders at a point in time when the company is at all-time lows. So the company is probably in the worst position it's ever been. In this current economy, the kinds of rates Tattooed Chef will get are not going to be good. And if they dilute shareholders, they would need to add a lot more shares in comparison to if they diluted when the company was $15 a share at the beginning of the year. When we look at the full year guidance, this doesn't look good for the fourth quarter either. The company brought down their revenue guidance from between $280 million and $285 million to now in the range of $235 and $245 million. That is a 15% decline in their guidance for the year from midpoint. And after the earnings release, analysts have the company generating about $258 million in revenue, and I wouldn't doubt seeing this number fall even further. In terms of Q4, this would mean that the company from the midpoint is expecting to grow about 6%, which is extremely low for what the company was expecting. Lastly, their expected gross margins also declined from 8 to 10% to now between 0 and 3%. This is something that they need to get straight and quickly because they don't have the cash to last another year in this kind of environment. So when I consider all of the risk with this company, in my opinion, it's hard to see this company being a large part of anyone's portfolio. However, despite this rough year, Jeremy is continuing to hold his shares. I don't believe the issue is Jeremy investing into TTCF. I think the even bigger issue was the fact that this was his number one position, and now despite the issues that are going on with the company, he still wants to hold his shares, and this is probably still a massive position for him. And I know from experience that it is easy to just buy a company based on the fact that there is huge potential. But when emotions get in the way of my investing strategy, I lose money every single time. And if I'm honest, I think this is what's happening to Jeremy and his tattooed chef position, because even now he says that he hopes that the company will produce better margins. If I'm an investor, I would not want my investments, especially my number one position, to be built off of hope. So after seeing freight costs significantly off their all-time highs, their small cash position, and a high likelihood that they need to raise capital or debt, I don't know what they are going to do differently in the short term that could help them to have better margins for 2023. Now, what I find interesting is that Jeremy made a video explaining how he needs someone to keep him accountable so a situation like this doesn't happen again. Clearly, he knew that making Tattooed Chef a massive position was a mistake. And this is a major reason why I believe that stock YouTubers need to talk about the risk of each company more. What we saw over the past couple of years is that many people, including myself, talked a lot about the reward potential and very little about the risk. And this is a disservice to anyone who wants to watch videos about different companies to invest in. So if you're interested in knowing more about the risk of the companies I'm invested in, let me know in the comments down below. That way I'll know to make more content like this. And speaking of risk, I firmly believe that companies who are unprofitable should never be the majority of anyone's portfolio. What we saw over the past year is that many large cap companies that have pretty easy business models to understand have had their valuations cut drastically. And this could be a tremendous opportunity if you are interested in getting into large companies or if you are new and starting to learn how to invest. Over the past year, I shared that the companies investors will want to stick with are those who are either going to be profitable in the next year or are already profitable. But that doesn't mean I don't own speculative plays. I still own companies like Shift and Opendoor, but in comparison to my overall portfolio, they make up less than 10%. So when I look at my portfolio, I feel very confident going into 2023 because many of my positions have been built out, and this gives me the option to start new positions in the near future. So if you're interested in seeing what those positions are, make sure you subscribe to the channel, that way you're notified when new content comes out. Hope you all enjoyed this video, and I'll see you in the next one.